Well, as promised, let's get to our first guest on the show. Marc Franklin, Deputy Head of Multi-Asset Solutions at Asia at Manulife Investments is with us. Marc, great to have you in. Thank you so much for joining in. So let's start with the big Q. I think markets the world over are anticipating this 25 basis points rate cut from the Federal Reserve. What does that signal? I mean, it's been pretty much a Goldilocks scenario for the US market, right? Growth is okay, inflation hasn't spiked, the Fed is cutting. So we keep rolling into the new year on a positive note then, as far as the US is concerned.
Good morning. We'll have to wait and see to what extent the narrative around the policy decision is trying to strike a balance between being guarded somewhat for inflation, but also fulfilling their full employment mandates. The market's expectation is probably for a hawkish cut, as in Chair Powell effectively highlights that there'll be data dependent from here on in, and that one shouldn't expect the rate cut cycle to be on autopilot. It will be meeting to meeting. And so you might see the dot plot remove a cut from next year. Then the question is whether the market reacts to that, whether the market holds its ground and still expects 2 to 3 rate cuts next year. The bigger question really, though, is that the fiscal side is really a case of attempting to run it hot. You know, large fiscal deficits, pro-cyclical policy, and then the extent to which the monetary policy side will try to facilitate that or lean against it because they're concerned around the risks of inflation starting to move back higher again. If you look at bond markets in the US, they're starting to discount that prolonged period of large fiscal deficits, a bit of rising term premium, higher yields, and in fact also the fact that some of the more recent data, which we've been starved of, has come through quite solidly as well. So there is reason why the Fed may not want to indicate that there are many more automatic cuts to come, but it's going to be about threading the thread through the eye of the needle in terms of placating concerns around a retightening of financial conditions.
Marc, hi, morning. This is not a normal president, right? President Trump is unlike any other, you would agree. He's openly, and just look at what is, even as the FOMC is expected a cut and everyone is saying, well, maybe it's going to be one cut and then we'll see. In an interview to a newspaper magazine last night, President Trump essentially saying, well, you know, the litmus test for whether who gets the job as the Fed chair is going to be how fast, how deeper rates can be cut. Now, Kevin Hassett, who's seen as a front runner, echoed that sentiment just last night, saying, well, a lot more room for more than 25. So as we enter 26, you know, it's going to be, if we're going to actually see that they're going to be able to force their will upon what the Fed does. I don't know if they can. The market will have to reprice. I just wanted your thoughts.
One of the things that we're grappling with at Manulife is the extent to which whether the market will somewhat look through the policy decisions that we get at this meeting and maybe the next meeting and start to really discount the post-Powell Federal Reserve from the second half of next year onwards, because the expectation will be that whoever is in place as chair, and to some extent the composition of the voting committee as well, will probably pivot to a more dovish stance. And therefore, does the market really care so much about what the policy decisions are now and the discussions around that? Does it care more about discounting the likelihood that the complexion of the committee, as well as the chair, will change from the second half of next year onwards?
Okay. All right. Marc, good morning and good to see you win. I recall you saying that, you know, you're seeing some kind of stability in the Indian markets, but you're still neutral. You're holding on to that stance, or do you believe 2026, India could be one of the top performers post the kind of measures that have been taken by our central bank, our central government as well, and earnings in all probability, I live in hope, it's going to pick up next year?
Yeah, if you look at the sort of the drivers of performance within Asian equity markets this year, those markets that have done best, so for example, Korea and Taiwan, they've generated their returns from a combination of a strong earnings cycle as well as valuation multiple re-rating. Now, those markets are probably closer to the upper end of their historical trading ranges, and therefore, as we roll into next year, the low-hanging fruit in terms of multiple expansion is probably a lot less than it was at the start of this year for those types of markets. So then it all comes down to the extent to which earnings growth and upward surprises around earnings momentum can catalyze fresh buying flows into those markets. And India is roughly in that camp as well. There's probably not a great deal of room for valuation multiples to expand. And then it comes down to the extent to which the earnings cycle and the growth cycle from a macro perspective surprises to the upside. Now, one incremental risk at the margin for India, which I think is the reason why the market's been held back a little bit in the last 1 or 2 weeks, is the question mark around sourcing of crude imports and the extent to which that mix will have to shift away from Russian crude imports towards higher priced imports. And that then affects the current account position. And therefore, that's why you've seen some currency weakness. And then if you think about foreign investors, they're looking at in dollar returns or equalized currency returns across all these markets. So the currency is an important component, as well as the local market currency returns as well.
Quick last point to just go back to the Fed, Marc. When all this started, the market I remember the volatility, right? When it first dawned upon the market that White House seems to want to call the shots at the Federal Reserve. But now as we get into that second half of next year, which you alluded to, will the market be happy with the dovish Fed, or do you think the market will have an issue realizing that the White House's dominance on the Fed is for real?
Well, I mean, one sort of scenario you could paint is to say that the front end and shorter duration equities respond well to a dovish-leaning central bank, which is then aligned with very easing fiscal policy. But on the flip side, the longer end could continue to see higher yields as a result of rising term premium, but also rising risk premium as well. And so that's a scenario where the markets will be able to have their cake and eat it in terms of creating investment opportunities across the curve. And then that has implications for which factors and styles within equity markets do well or struggle a bit.
Okay, well, I think we can safely then say that 2026 is likely to be a very, very interesting year, especially for the US bond and treasury market. Thank you, Marc, very much for joining in. Appreciate you taking out the time today.